let us have a refresh on how should we classify liabilities. According to Philippine Accounting Standards 1, the accounting standards used to classify liabilities as current or non-current. Current liabilities are those that are expected to be settled within the entity's normal operating cycle. A little bit refresh in your financial accounting and reporting, normal operating cycle is different from your accounting cycle. Second, if the liabilities are held for purpose of trading, meaning it is under your normal course of business. If the liabilities are due to be settled within 12 months, so let's say your accounting year end is a calendar period, so that will end on December 31 of year 2024. Then, if a liability is due to be settled 12 months after year 2024 or December 31, 2024, then that should be considered as your current liabilities. Then the fourth one is that if the entity does not have the right at the end of reporting period. Our reporting period, we have two. We have the calendar period and we have the fiscal period. To defer settlements beyond 12 months, that will also be considered as current liabilities. Another point of consideration is when a long-term debt is expected to be refinanced under the existing long-term facility. So when the entity has a discretion to extend the loan, then that will be considered as non-current liability, provided that if the liability is due within 12 months, if the entity has the right to extend the payment or the date of settlement, then that is considered as non-current liabilities. A liability can have an explicit interest rate or an implied interest rate. It is an explicit interest rate if there is an stated interest rate in the contract. For example, you borrowed money for 3 years, then the interest rate is 10%. So it is stated in the contract that you're going to pay 10%. So it can be compounded or it can be a simple interest. Then we have the implied interest rate. Implied interest rate is commonly used for the short-term borrowings. Implied interest rate, unlike explicit interest rate, so it is not explicitly stated in the contract. Let us try to answer question number 5. A measure of company's long-term debt paying ability. Letter A is incorrect because return on asset is an example of a profitability ratio. It is a profitability ratio because we are relating the profit to the total assets. Letter C is incorrect because dividend payout is more concerned with the movement of the stock prices. It is related to the growth of the stock prices. It can be related to an increase or a decrease in the stock prices. Letter D is incorrect because the operating cycle relates to the liquidity of an entity. Meaning to say, the shorter the cycle is, the lesser there will be liquidity risk because you will count the number of days from the moment that you sell a product up to the moment that you will collect cash or collect payment. Correct answer is letter B, times interest earned.